I think a lot of the ingredients that you look for when you're trying to match up the market action to the textbook bottoming action were met today. You did see this sort of spike in the VIX. You know, it came down off of its highs.
Right, but we went back up to 40 on the VIX
Yes,
today,
but that's what you want to see. You want it to surge.
Surprising.
And down, it creates a spike on the chart. That's one ingredient. The intensity of the selling, both yesterday afternoon and in the middle of the day today, was, I think, of the kind that you could call climactic. You also did have this report making the rounds after 3 o'clock from JP Morgan. They were saying, look, that kind of forced selling activity from the commodity trading advisors, these hedge funds, leverage hedge funds, other types of systematic traders, looked like it was just about done. And I'm pretty persuaded that had a role in people's boldness in buying into the close.
This is a weekly note they always put out, and they're talking about the risk parity funds, just saying usually what happens if you have equities, bonds, and commodities all going down at the same time, it's a terrible recipe for them. Right. So does that, you know, we were up, so everything was going right, and then all of a sudden everything was going wrong.
Yes.
Is that enough for them to say, okay, well, now we have to dramatically reposition ourselves? It took us a week to do that, and now it's done?
Yeah, that's kind of how it is. It's like, okay, let's bring our exposures down. Hey, now that being the case, that wasn't the whole story of this. This has been a reset of the market in terms of valuation, sentiment, and positioning from extremely extended levels in January. So even if this was the low in the last couple of days, it doesn't mean that we're back to the melt-up type market. It's still 10% up from here in the S&P. To get to the old highs, and you're down 5% in a week. This is not a stable tape just yet, but this is encouraging what happened today.
Rene, if we're not going back to that melt-up territory, is that actually the healthiest development that this market could have given you?
Well, you know, I don't think we're done with this yet, Kelly. I think we still have a little bit more of a bump on the downside, and there's some pretty key factors that are going on right now that we really need to kind of keep in our minds. Number one, we're moving from a monetary-driven economy to a fiscal, and that's a bumpy road. So the market is a forward-looking beast. It is incorporating that into this whole concept, and it's going to take a while for us to get through that. We're also seeing higher inflation. It's creeping up a little bit, higher interest rates. We're almost at 3% on the 10-year. We also have seen unemployment drop tremendously over the last 45 years. So that's also going to, you know, put us on the side of potentially some wage growth, and we're already starting to see that. So we've got all these factors that are kind of kicking in right now, and I think that it's going to take a few weeks to maybe a couple months for things to settle in. I am very positive on the year.
That's exactly what I wanted to hear is, you know, so fine. So we have some choppiness in the market. So fine that some professionals and some strategies aren't having a great week. But broadly speaking, you know, and again, there's all the reason why we should have been worried about how fast we were moving higher in the market earlier this year, right? No one wants a stock market bubble. We don't want it a bubble going up. We don't want to deal with what happens after that. So I guess that's why I'm asking if you think in part this could have been a healthy correction.
It is a healthy correction. And I know a lot of our clients have been asking us, you know, currently right now, is it time to buy? And they were very concerned that we were going straight up. So it's healthy. People are having a sigh, you know, a sigh of relief a little bit. But I do think we've got some more downside that we're going to see before things start to settle in.
All right. And by the way, how long of a correction are we talking? David Katz, what do you think? Goldman's chief global equity strategist, Peter Oppenheimer, said in a note, the average bull market correction is 13% over 4 months, and that it takes 4 months to recover. David, if we had 13% in a week, does that mean we only need a week to recover?
Well, generally, actually, the quicker the correction, if they're not economic-based, the quicker the recovery. So we think that at least 2/3 of the correction is over. We would be buying into this weakness. A day like today when the market's off pretty sharply by midday, we'd be aggressively buying into that. You might look stupid in a day, you might look stupid in a week or a month, but we think 3 months from now stocks are going to be a lot higher, and we think the recovery is going to be quicker. When you have quick corrections, you have quicker recovery. So we don't think it's going to take 6 to 8 months. We think you could be moving in a much better direction 1 to 3 months out.
Yeah, you can't be afraid of looking stupid. First they ignore you, then they laugh at you, Mike, then they fight you, then you win.
Yeah, I don't know if Gandhi was a trader, but maybe it applies here as well.
You might have had a good discipline for it.
You might have, yes, exactly. Would have you really been able to stick a lot of this stuff out? To David's point, if this was the kind of a jolt, a volatility shock that we got in the late 90s, those were the types of sharp corrections that we got, not associated with a recession, that yes, you did recover quickly. Again, I can't say you'd want to lay a lot of money right now that's exactly what we're going to do, just because of how extended we were. But everything seems to be compressed these days. We're down 5% in a week, and we're walking out of here for the weekend thinking it's a win. So who knows exactly if that can be turned upside down on Monday, just because, you know, today's rally was just technical or short.
You surprised the sentiment was so positive on the close here? David, go ahead.
With this correction and with the earnings that are growing very nicely, the market is down to about 16.5 times earnings. And in a low inflation, low interest rate environment, that's quite reasonable. So we think that does set the tone for better times. Businesses are doing well. Earnings season came in great, and the outlooks were very positive. So all is not lost.
When you say low inflation, low interest rate environment, that's precisely what's being debated. David, you don't think we're at some kind of inflection point on those fronts?
We felt that interest rates would be moving up, but 2.8%, 3% is still very low based on long-term trends. So we don't think that derails the market, and we don't think inflation is about to wage out of control. We think it's drifting higher, and in certain respects, that's okay, but we don't think you're going to see a spike in inflation.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.